All right, we are back. Stocks continuing to bounce today following news of that trade agreement with the UK and hopes of progress with China as talks are now set to begin this weekend in Switzerland. Here to share where she's positioning right now, JPMorgan Private Bank U.S. equity strategist Abby Yoder. Welcome back.
Thank you.
Are you feeling more bullish about the environment that we find ourselves in? We bounce back a long way, and we get incremental positives related to trade as well.
Well, I don't know that we ever weren't bullish. We're like near the low end of our wide range for the year-end target, 5,700 to 6,200. And the risk, more towards the downside on the 5,700 was that we didn't get more clarity quicker, right? And we're starting to get that. Obviously, this UK deal is a big move forward. Whether or not that can act as a framework for other countries remains to be seen. I think there's a lot of differentiation. But I think for us, 1Q earnings season was really strong, understanding that's backward looking, but we didn't get those guidance cuts that I think a lot of people were expecting or a lot of investors were expecting.
Yeah, for sure.
So, yeah, we feel pretty good about things right now.
Even with that, Adam Parker was sitting here and is like, I hear all that, but it's too late. A lot of the damage has been done from the tariffs already. It just is a lag effect. We haven't seen the worst of it yet. How do you feel about that?
I think that's I think that's the common narrative, right? That okay, we're about to go we're not in recession yet, but we're about to go in recession. And I think it's important to keep in mind the starting point. We're just coming from a really strong position in the U.S. from both an economic standpoint, growing above trend GDP growth for the past 2 years, from an earnings standpoint, profit margin standpoint. So I think there's a lot of pain that can be tolerated from the economy and companies. And I think it's also important to keep in mind, there are growth positive policies that are, next in line to be implemented by this administration. And we're only in May, right? So we've had the growth negative policies implemented up front, which is very different than Trump 1.0. But we do still have that deregulation, tax extension in the pipeline that I think could.
Well, that's what the president himself tried to make the point of today in the Oval Office, right?
Yeah.
Buy stock on that view. We're going to get trade deals. It'll be debated from here to eternity what kind of deals they actually were, but trade deals plus extension of tax cuts plus deregulation. Yeah. Buy stocks. That's what he said.
Well, and I think, removal of the AI diffusion rule was an important thing, right? It's nuanced. It's not as carte blanche as it was before in terms of you can buy the entire market and it's really easy. It's going to be much more nuanced. But a step in the right direction from a trade deal perspective. And then again, from a regulatory perspective, you've seen it at the margin with financials, but then to see that AI diffusion rule now pending what it's replaced with is very important.
Right.
But I think is a strong signal to markets.
Within the nuance, where do I really want to lean into right now, if anywhere is worth actually leaning into?
Yeah. Well, I think software, I think it's a really interesting spot in that it still is pretty under-owned. No one's really gone back to that space from a hedge fund perspective in terms of positioning. And it's still, relatively attractive valuation, especially relative to semiconductors, which have a lot more tariff exposure, obviously. And just think about the earnings results that we've gotten from a lot of the hyperscalers over the past couple of weeks that are, not only continuing to spend on AI, but actually starting to show, green shoots of monetization of that and ROI to a certain extent as well.
We've had a pretty good conversation. We probably talked about it the last time you were here, and it doesn't seem to be fading, this U.S. exceptionalism trade, whether money is going to continue flowing out of the U.S. towards better opportunities that are perceived to be elsewhere like Europe. How do you see that here?
Yeah, I don't remember if we talked about this last time. I think there's an argument to be made from a portfolio construction standpoint that it makes sense to have, assets in your portfolio that are not only U.S. dollar denominated. And that's not calling for the end of U.S. exceptionalism. It's just thinking from a smart portfolio construction standpoint, right? And that's really because starting place matters in terms of the dollar, and it was, overvalued on various different metrics. And so we're not calling for the swift depreciation, but over the longer term, thinking of that getting back to fair value and having other assets in other currencies is just a good, prudent use of capital.
Europe is on your list. So is Japan. Why did you pick Japan?
Japan's just in a different place than it has been over the past 20, 25 years, right? I think the one thing that's a net negative for Japan is that their earnings are going to be hit more negatively from a stronger yen than if you look at euro. So for the yen, if you see a 10% appreciation, you usually see like a 5% hit to earnings in Japan, whereas in Europe, that's more like a 2% hit. So there's that. But I think, they're first in line for trade talks. You're really seeing that corporate reform play out. You're seeing buybacks up over 100% year to date. So you're really just starting to see green shoots in terms of that economy.